Do you ever feel stuck, like you're living your life on autopilot? Are you ready to shift into high gear and reach the success you so richly deserve? Welcome to the Play Big Movement podcast. I am your host, Sharon Lechter, entrepreneur, business strategist, and best-selling author. Playing big is not about settling for good enough or being comfortable. It is about reaching your highest potential and achieving your greatest success. Join me in my Play Big movement as I interview top experts in business, money, and entrepreneurship, all ready to serve you and to help you play big, be number one in your field, live your legacy, and create maximum impact. Hello, everybody. Welcome back to the Play Big Movement podcast. I'm very excited today because I have a new friend on today with me. And the topic that he's going to share with us is something that's very important if you want to really, truly play big. Ty Crandall, welcome. Thank you for being with me today.
Sharon, thanks for having me. I'm excited to be here.
Well, you actually had one of your folks had reached out to us to talk about possibly talking about doing some things together. And I was delighted to hear what you do and think it's something that everybody should hear about. And so that's why we invited you to be on the Play Big Movement podcast. Ty is the CEO of Credit Suite, and he is an expert, one of the experts in obtaining and maintaining business credit. He's written a couple of books. They're called The Perfect Credit and Business Credit Decoded. So it's actually a very important topic that a lot of people don't realize. You know, when I talk about personal credit, I always have to remind women that even though they get married, they still have their own credit score. Same thing in a business. You have your personal credit score, but the business also develops its own credit. And so this is an important topic for anybody who's get the foundation of your business set up. You do it right. You have it in an LLC or a C Corp. But then you also want to make sure you have the funding and the opportunity to get the funding you need. And business credit is a very important aspect of that. Now, in other segments and other materials, you talk about personal guarantees. Well, Ty's here to help us kind of like wade through all of those issues. And he is the expert. So it's a great opportunity to get the scoop and understand how you can start now to build your credit. And he's actually, you see behind him, the Tampa Bay Buccaneers. So most of you know that I grew up in Orlando. So it's always nice to be talking to another Floridian. I didn't tell you, Ty, I am a Seminole. I don't know where you went.
Oh, we're going to have to end this now.
Are you a Gator?
I'm a Gators fan, but that's okay. No hard feelings. I was adopted to that. My wife's whole family are Gators fans, so here I am.
I graduated from Florida State. However, my niece got her graduate degree at University of Florida at the Gators. So
she's a very wise woman.
I give her a little bit of pass. So, but so tell me. You know, I think let's just start at the beginning. So the people that are watching or listening, the importance of business credit, because you don't really hear a lot about that when people are just starting up their businesses. And it's really important to get started on the right foot. So give us a little background on how you got into this, number one, and give a little advice you have for people on why it's important to start early.
Sure. I think why I got into this was why it's important. You know, the first business I ever opened was a mortgage company in the height of the mortgage industry. And I was there for the whole collapse. So, you know, I saw firsthand how even when you do all the right things in a business, how things completely out of your control can come in and impact what you do. And that impact to us was that we completely lost our ability to deliver what we did, which was mortgages. And, you know, 6 months later, when we gained back that ability, we were doing it at 90% of our business we no longer had. So what happened was eventually the business kind of slowly died and failed. And because I made the same mistake a lot of business owners make, I personally guaranteed everything for the business. And, you know, I used my personal credit to be able to sign for business credit cards. Then what happened was kind of unexpected. I'd had really high credit limits on my personal side. So I said, well, you know, if I ever get in trouble, I have all these assets and I have these limits and you know, I have that to fall back on. But when the business kind of started to falter, what happens is things started to go late. Those reported on my consumer credit report. Then all my consumer credit issuers lowered my limits to what I owed. And eventually those business debtors would come after and take all my personal assets. So because the business had issues, it wiped out my personal credit and wiped out my personal assets as a result. So that's where years later I would open a consumer business and I would discover what business credit was. And I really realized how things are supposed to be, that consumer credit and business credit are supposed to be separate, that business credit can help you fund the business without you needing to personally use your credit to do so. And you don't have to personally guarantee those things either. So if anything does happen, like it did in my life, that's unexpected, then you're not personally liable for those business debts. Those business debtors can't come after your personal assets. So, that separation of personal and business credit, the separation of personal and business liability, this is why Entrepreneur and Inc. and NASDAQ and SBA, all these financial authorities so strongly and highly recommend the separation of consumer and commercial credit.
Well, and it's so very important, but it is true. I mean, I still remember the first business that I started when I moved to Wisconsin many, many years ago. I did a woman's magazine with two friends, and it was highly successful. I sold my interest when I moved to Arizona, and years later I get a call because there was we did a copy machine lease in which we all personally guaranteed it. And the gal that had sold the company just kind of walked away from the lease. And so they came after the person with the deepest pockets and said, hey, pay up. And so I had to go back. It was totally crazy because from that point forward, I always made sure I read the fine print. And you can easily get caught up in those personal guarantees without even realizing it, unless you're paying attention to everything that the contracts you're signing have in them. And so for someone out there right now that's listening or watching, and they're saying, well, yeah, it's easy for him to say, but I've always had to personally guarantee everything. What advice can you give them for getting that transfer from that personal guarantee stuff when they're starting their business to start setting it up as a business credit situation?
Well, the one thing to know is that personal guarantees, if you look at the definition of them, they're required basically because your business can't stand on its own, right? So we know it's possible when we look at companies like Dell. We know Michael Dell is not personally guaranteeing when the company gets a credit card or credit line. So we know at some point in some level of the business, it's possible to separate that liability. But I think the myth is that only bigger businesses can do so, when the reality is that any business can separate consumer and business credit, just like you started with no consumer credit and you got small credit cards and eventually worked up to auto loans and mortgages and loans. A business can do the same thing. And as the business establishes more credit and they establish a credit profile with more accounts reporting, or what we call trade lines, then the more trade lines they have, the more credit and the more financing becomes accessible without needing that personal guarantee. So what happens is credit issuers are able to, your business owners are able to leave their Social Security number off an application. Credit issuers are then forced to pull the commercial credit report and score instead. And if the business has a report and score showing they paid their bills and accounts that they're reporting that are being paid as agreed, well, then what happens is the business doesn't need the business owner to sign as that guarantor. So the key is to start building a commercial credit profile for your business, just like you did as a consumer. And the more you establish that credit profile, just like you did as a consumer, the more things you can purchase without that personal guarantee, without that liability.
Well, and I know when we early on in Pay Your Family First, one of the companies we run today, we literally didn't have a business credit line because I didn't need it. It was basically a successful company. But when I wanted to create that and show that stability and get that kind of credit rating established, I went back to my suppliers and we ended up being able to get some credit established. So for someone out there that wants to get that process started, they may already have built up a history of credit, but they just haven't been having it reported. So what's the first step for someone to make sure that they start setting up their business credit?
Well, you hit on a couple points there. The first thing is to get money before you need it. Business credit can be built much faster than consumer credit, but you don't want to wait till you need money to start doing this, because at some point in most businesses, you're going to need capital. You're going to need credit cards. You're going to need loans. You're going to need credit lines. Every one of those factors in business credit quality. So if you want to be able to have the best chance of getting financing in the best terms, you should start building business credit very early on in your business. You also touched on another point that, you started to go to your suppliers. The problem that we have in the commercial space is that 97% of trade vendors do not report to the Business Credit Reporting Agency. So many people that you and I and your listeners have credit with, they don't report that credit to Dun & Bradstreet or Equifax or Experian Commercial. So we run into this all the time where business owners think they have business credit. They go into their bank to get something they need financing wise. They're denied because of business credit quality, only to then discover they don't have any business credit. And in our world, in the commercial world, the reporting agencies will give you a failing score even if you have no credit. So it's something you can't run from. So the steps to take to start building it really starts with first setting up your business credibly, making sure you have a business website and a professional email address, not a Yahoo or a Gmail type email address, that you have a business phone number, that you're not using a mobile or a personal or a home phone number, that you have your business listed the same way everywhere online. Yelp should be the same as Bing. It should be the same as your website, because in the reporting agency world, that's where they get their data. They get data from Yelp and Facebook and all the sources they can. So the congruency of information, making sure it's the same information is important. Getting your phone number listed with 411, having a fax number, having a real business address or a virtual address and not using a UPS address or a PO box address. All those things tie in to legitimacy, credibility. And that's the first thing that any lender or credit issuer is looking at to see if you're a legitimate, credible business. Once you've done so, the next step is to, start coming in and getting credit that does report to the reporting agencies. Now that we've addressed that most of it doesn't, you've got to find creditors that will give you credit when you have none, and that report that credit to the reporting agencies. So some are Uline and Quill that sell shipping supplies and office supplies, and Gimplers and Granger are some other great sources out there that sell outdoor supplies and all kinds of other things that business owners can use. These companies are very unique because they'll give you credit when you have none. They report the credit to the reporting agencies. And as long as you're paying that credit as agreed, that's what will give you a good profile, a good score. And that gives you really the foundation you need with about 5 of those accounts to start getting the Staples and the Amazon and the Lowe's and the Home Depot, the store credit, the retail credit that's out there. So it's just a step process, but it starts with setting up the business credibly and getting some of those vendor accounts to establish that initial credit profile and that initial credit score.
Well, you mentioned Dun & Bradstreet as well as a couple of others. Talk about the reporting agencies that actually are the ones that people go to get the kind of business credit.
Well, in the United States, we're familiar with Equifax and Experian. They're, 2 of the biggest consumer reporting agencies, with TransUnion being the third. TransUnion is really not a player here in the United States with commercial credit. Instead, Dun & Bradstreet is. And Dun & Bradstreet is the biggest business credit reporting agency that exists. In all reality, they're the biggest credit reporting agency that exists when it comes to even consumer and commercial credit. They've been around since 1841, well before even the first consumer reporting agency ever showed up on the scene here in the United States. So Dun & Bradstreet, Equifax, and Experian Commercial, those are the main reporting agencies in the United States that every business owner should know about. And those will be the ones that you're going to want to build credit with to start being able to get approved for loans and credit lines without a guarantee or eliminating or limiting the amount of credit and financing you get with a personal guarantee.
So we know our personal credit score, we're looking at, under 900, 800 and up is perfect, 750 is good. What's the range and how is it monitored for business credit?
Business credit scores are very different than consumer credit scores. First of all, there's a lot of them. When you pull a business credit report, it's very common for you to see 3 to 5 different scores on there. Then they all depict different things, different financial risk, and performance scores of how you performed, and predictive scores of how they think you'll perform. But in the business credit reporting agencies, in the business credit agencies world, there's 3 main scores. There's what's called the Dun & Bradstreet Paydex score. Experian has something they call Intellis score. And Equifax, they have a score called the Small Business Risk score. And these scores are primarily based, Equifax and Dun & Bradstreet are solely based on how you pay your bills. So it's really reflective of how you pay. If you pay early, you get a score that reflects you pay early. If you pay late, how low your scores are reflect how late you pay. And so I like that in the commercial world because it's very easy to get good scores. You only have one thing to do. You just get credit and pay the bill on time. And as long as you get that one thing on time or early, that's what will get you a good score.
So I hope everybody's been listening and taking notes, because it is a very different system. Like the FICO score has lots of different aspects that go into it. So for your business credit, it simply is paying your bills on time. And so if you find yourself with some dings on your credit score from a business perspective, are there things you can do to clean it up or just continue going in the right direction?
Yeah, sure. It's a different world than the consumer. We're used to credit repair in the consumer world because of a law called the Fair Credit Reporting Act, which was, started by our government in the 70s to prevent inaccurate and fraudulent information from coming on the credit reports. But in the business and commercial world, there is no such law. The Fair Credit Reporting Act doesn't apply to commercial credit reports. But the reporting agencies will still work with you. Dun & Bradstreet has a service called iUpdate, and Experian and Equifax, through their online credit monitoring services, will let you go through a process to dispute items on your credit report. Now, it's different, a little interesting, because if you pull your commercial credit reports, they don't say your credit issuer name. So, for example, if you see Staples on your commercial credit report, it's the category, their business category. So it would just say office supplies. So you really should keep an eye on your credit report to know each line item, which credit issuer it is, because the reporting agencies won't even tell you that if there is an inaccuracy. And then if you find an inaccuracy, you want to go directly to the reporting agencies to dispute that information. And typically within 30 days or less, you can get it updated or removed completely from the credit report.
Well, this is incredible information and something that, in order to play big, you need to be in this arena. You need to have your business credit set up and monitor it to make sure it stays healthy. Now, I made a comment earlier in our conversation that I talk about entity structure. Is there something that people need to know about how they hold their business and what entity they're in?
I think you hit the nail on the head. You mentioned an LLC or a corporation. A business could choose any entity, and any entity can build business credit. But the problem with sole proprietors, the problem with partnerships is that those entities, you are the business. So you can never really separate liability. If the business gets sued, you get sued because you and the business are one and the same. So, if you want to really separate liability, you should choose a corporation. You should choose an LLC, because those limit your liability and they separate the liability. So if the business gets sued, you can't get sued. Again, I'm not an attorney, I'm not giving legal advice, but when it comes to business credit building, that's a big deal, because if you ever did default on credit cards, then what happens is they can come after the business and they can't come after you. So in my world personally, that would have made all the difference, because the money I'd saved wouldn't have been taken by my business debtors. And that's exactly the same protection that every business owner really wants to accomplish.
Sure. And in our essential components of the successful business course, we talk about the good, bad, and the ugly ways to do business. And the bad is sole proprietorship, because you're not sheltering anything on your personal side. So you want to make sure that you get into the LLCs, limited partnerships, limited liability entities. And the ugly is general partnerships, because you're opening yourself up not to just your own mistakes, but your partner's mistakes. And so you truly are creating a huge target on your back. And so that's why it's so important to have yourself in the right type of entity and then build credit within that entity. And so from a standpoint of people that may be listening or watching this, Ty, what do you see as like the common mistake people make, other than not getting their credits set up? What do you see happening?
I see a few mistakes. I see that people don't go to get money until they really need it. And then perpetuates this whole myth that, you have to have credit or to be able to get credit, or that lenders don't lend when you really need it. Well, lenders don't lend when you're desperate. And, it's easy to see when you're desperate, because that's when you've maxed out all your credit cards and you're going in begging for help. So I think getting credit before you need it. SBA says that management mistakes and lack of access to capital are the two reasons that businesses fail. Well, that makes sense. As entrepreneurs, we don't know what we're doing. We just make it up as we go. And, we need the capital to support us when things don't go our way or the unexpected things happen. So I think, preparing for the unexpected and getting access to especially revolving credit before you need it is a big deal. Another big mistake is that people put a Social Security number on a business loan and credit application. Look, you're going to probably need to personally guarantee loans well into the future until you establish a lot of business credit and your business grows. But you can get $20, $30, $40, $50,000 limit credit cards easily within 6 months or less without the guarantee. But the key is that the minute you give a Social Security number, you're providing a personal credit check, you're providing a personal guarantee. If you don't want those things to happen, you have to avoid giving the Social Security number on the application. If you do that, then you force them to pull the EIN credit and make the decision based on that. Now, in a lot of people's case, it's not their mistake. It's the credit issuer, the front-end people that work with these credit card companies are telling them they have to, because they don't even know better. They don't even know about the business credit system. So you need to know you don't have to provide the social. There's no law that says that you have to provide it on an application. for credit. And at the exact same time, you need to know that if you do provide it, you're probably going to attach a personal guarantee and a personal credit check. Now, the other big mistake that we see people make is trying to build business credit in the wrong order. They say, okay, I listened to Sharon's podcast. It sounds great. And they go right into their bank to try to get a credit card with only their EIN. Well, nobody's going to give you credit unless you have credit established. So you have to go and get those vendor accounts, then get revolving store credit, then probably with about 14 accounts reporting, then you can start to get Visa cards and MasterCards. So you have to follow those series of steps to make sure you do it the right way. And probably the last mistake I'll mention is that, people that do wait too long and use their personal credit, the problem is that utilization affects 30% of your consumer FICO score. What that means is when you put balances on your credit cards, that affects 30% of your score. To give you an idea what that means, payment history is 35% of your score. So, FICO is telling us that, the balances and keeping low balances on credit cards is equally as important as paying your bills on time. That's what the math of FICO tells us. So when we see business owners try to use personal credit to fund their business, then what happens is they max out those credit cards, they completely tank their credit scores, then they're out trying to solve the problem, and it's typically too late. Their ability to get loans and credit lines on the consumer and the commercial side is ruined because they've ruined those credit scores. So those are probably some of the most common mistakes I see that somebody should.
And that I can't underline that enough. Rewind and listen to that again, because that's what we see all the time with people. And it even happens when they have a successful business but yet they can't get the funds to help fund the growth of the business because they've maxed out their personal lines and impacted their personal credit score. And
that's what's interesting about business credit. Business credit's designed for it to help your business fund itself. It really is what it is. But when you try to use these personal methods because they're easy or accessible, and you're trying to do something it's not meant to do. Consumer credit card limits are 1/10 or 100th per SBA of what they are on the business side for a reason, because you don't need a 10,000 at Dell as a consumer. You're never going to put 10 grand worth of home computers in your house, but you need it as a business. So limits are much higher on commercial credit cards because they know you're going to use more money. But when you try to use consumer cards with a fraction of the limit of what you really need to do it, then that's when you're using something it's not designed to do. You're trying to put a round peg into a square hole, and then that's when you really start to see the scores plummet, as you described.
Well, this is one of the most valuable podcasts we've done, because it truly is something that people don't understand. They don't get it. They haven't done the research, and it's really not talked about very much. You have to really go looking to understand business credit. And so I really thank you, Ty, for being with us. And we're going to hold on to you for a minute and do another little recording that we're going to have in our private Play Big Movement Facebook page. So for all of you that haven't joined the private Facebook Play Big Movement with Sharon Lechter, please do, because we're going to dive into a little bit more of the things that we've seen and the fear. Because what happens when you're building your business and you're all excited, but you've tapped out all your resources, all of a sudden you're stressed out financially and you're in a period of growth, and it's not good. It's a double whammy. So we're going to talk a little bit more about that. But thank you so much, Ty. We appreciate you being with us. And for people, how can they find you, Ty, for more information?
We've got a great free guide that maps out in depth the steps to build business credit. And it's right on our website, creditsuite.com/EIN. So if they go to creditsuite.com/EIN, they can grab the free guide and get all the specifics of the 4-step formula to build business credit.
Well, thank you so much. We're so excited to have you with us, and we appreciate your time. All of you, keep going, rewind and re-listen to this, because it's a very important aspect of playing big so you can grow, not just build your business, but create it so you can scale it. You can't scale without the amount of business credit that you need to do it and to be successful. So until next time, take care. Thank you for listening to this segment of the Play Big Movement podcast. Please subscribe to iTunes and leave us a review, as well as join us in other areas of social media, Twitter, Instagram, and LinkedIn at Sharon Lechter, and for Facebook, author Sharon Lechter. Thank you so much and have a fabulous day.